We move now our attention to investing in the global arena, and joining me to discuss this further is Nick Lee, Investment Director at Ashburton. Thanks so much, Nick, for joining us this afternoon. Well, with all that's going on the global scale economically, uncertainty has become ever present, nervousness rife on the markets, and with that, anticipating a changing environment in which we live becoming key in managing investment decisions right now. How are you rating your ability to anticipate right now?
I mean, obviously anticipating in the short-term basis is very difficult, particularly given the huge number of uncertainties that are sort of pervading the markets at the moment. But I think if you look at the reaction in share prices, we've seen a very sharp correction. But what this is throwing up is very good value in a number of the big global companies that we're looking at, and I think if one takes a longer term view, we will a good sort of a focused portfolio of large global companies will actually provide very attractive returns on a longer term basis.
Let's take a look at where exactly you're looking right now, because I was chatting to an analyst from RCM just yesterday, and he was saying that they're going to be making a trip to Europe pretty soon. They're visiting the likes of Italy, Greece, Spain, and in search of those investment opportunities right now. And it's the time to pick the right strategic investments, as they said.
Absolutely. I think our focus is on the emerging market economies, because I think they've weathered the global downturn very well, and their economies are structurally pretty sound, principally because they don't have the huge sort of leverage excesses that the Western, which is hampering the Western economies. But I think what I'm looking at is companies that have exposure to the emerging market economies, because they're still growing. And that's through a combination of actually emerging market companies, but also big Western companies that have exposure in that region and are growing, and they're looking to grow that exposure in that region.
Why do you think valuations on those companies are still sitting low? Because we're hearing time and time again that a distinction needs to be made between those companies that operate in the developed world and those with that kind of emerging market footprint, and yet those valuations still sit so attractive.
In terms of the Western,
yeah.
They're getting wrapped up, obviously, with the concerns about their economies in Europe, the sovereign debt crisis in Europe, the problems about, the worries about a sort of a double dip in the US, and that has effectively brought valuations down, in my view, to very, very, very attractive levels.
So now it's time to be taking advantage.
Well, in my view, and I think what we're focusing on is a fairly concentrated portfolio of 20 stocks, fairly sort of from an asset allocation point of view, fairly neutral in terms of geography and sector. And really, I think that a major focus is, okay, you've got the valuations in terms of PEs, etc. But I think, to me, sustainable and a company that can sustain and grow their dividends will, over time, provide a very good total return. And I think that's what investors should be focusing on, is total return, rather than obviously on a short term, everybody's focused on capital, but total return actually over time provides excellent returns for the investor.
Of course, you've touched on the fact that this portfolio is very refined. You're looking at 20 stocks in particular. Could you give us a hint as to a couple of the stocks that you've got in that portfolio?
Well, I mean, interestingly, one of my favourite stocks at the moment is Apple, which is actually reaching an all-time high, or an all-time high at 416. I'm looking at a sort of broad energy, for example, is one of our focuses. So we're looking at BG, which has huge reserves, and the sum of the parts is substantially higher than the current share price. PetroChina is an excellent stock in terms of exposure to the massive China sort of need, their need for energy and power. In terms of power generation and infrastructure, I think Siemens and GE are very well placed on the power side of things. And then in terms of the consumer, I think Nestle, these are solid companies. Johnson & Johnson and Merck are trading at 10 times with 4% plus dividends, and a very sort of a good dividend payout on an annual basis.
Of course, we've cast that optimistic view on these companies, and just what is prompting you in that direction? Just how much risk are you pricing in? Because we've seen money flowing out of emerging markets in a very big way, and commentary has been that it comes as a result of the liquidity crunch being faced in Europe, not necessarily risk aversion, where we've seen investors simply pulling back on liquidity wherever they can get it from, and that illustrating the domino effect of the situation in the Eurozone. And it's just becoming more and more apparent, presenting, I would assume, a risk scenario for the growth that you talk about.
Yeah, I think the emerging markets, the emerging market economies seem to me to be, as I said, structurally very sound. In terms of the actual underlying equities, although they are large markets, they are very susceptible to asset sort of allocation changes. And when you get large Western flows out of those markets, it obviously has a much more dramatic effect on some of the share prices of emerging market companies.
Well, where equity should give you an above average return, medium to long term, let's look at your exposure just to wrap up in terms of asset allocation at the moment.
In terms of asset allocation, I'm very sort of neutrally spread amongst the regions, with sort of a third in the US, third in Europe and the UK, and a third in the Asian markets, the emerging markets. And in terms of sectors, we're fairly neutral across the board, with the exception of banks, actually, where we're on a relative, sort of against a benchmark, we're underweight.
Okay, well, that showing just cementing again, how a diversified portfolio is the best way to survive in these challenging times. Thanks so much, Nick, for joining us in studio this afternoon. Of course, Nick Lee is Investment Director at Ashburton.